This is John AG, and I'm about to show you the smoking gun that proves the silver crash wasn't a sell-off. It was a robbery. They told you silver crashed because nobody wanted it. They told you it was weak demand. They told you the speculators got scared and ran for the exits. They lied. And I have the evidence right here in front of me that proves they lied. Look at this headline. This is from SilverSeek, published February 5th, 2026. Read it with me. Large chunks of silver leave China and COMEX warehouses after latest price crash. Did you catch that? After the price crash. Not before. After. When the price went down, the metal went out. That's not how a collapse works. That's not how a sell-off works. When people panic and dump an asset, the vaults get fuller, not emptier. The metal piles up because nobody wants it. But that's not what happened here. The price went down to $64, and the vaults went empty. That is not a coincidence. That is a heist. I want you to understand what I'm holding in my hands right now. This is the forensic dossier. This is the crime scene report. I have the warehouse logs. I have the inventory timestamps. I have the statistical analysis that proves this crash was mathematically impossible under natural market conditions. And I'm going to walk you through every piece of evidence, line by line, number by number, until you see exactly what I see. They crashed the price to buy it cheap. And while you were staring at the red charts, watching your portfolio bleed, they were loading trucks in Shanghai. They were loading trucks in New York. They were moving metal from weak hands to strong hands, from the public to the whales, from you to them. The heist is complete. The vaults are drained. And now I'm going to prove it. But before we dive into the evidence, I need a roll call of the survivors. I need to know who held on through the chaos, who stayed disciplined when the algorithms were hunting your stop losses, who refused to sell when silver dropped 36% in a single day. Pause this video right now. Go down to the comments section. Tell me two things. Where are you watching from? Your city, your country. And did you hold or did you sell last week when silver crashed to $64? I want to see who the banks couldn't shake out. I want to see who's still standing. Because you're the ones they couldn't rob. Comment now. I'll wait. All right, let's begin the investigation. I'm going to start with the hard data. No speculation, no theory, just the numbers that came directly from the warehouse logs. COMEX, the commodity exchange in New York, the place where the paper price of silver is supposedly determined by supply and demand. Let me show you what happened to their inventory. As of early February 2026, COMEX has lost approximately 50 million ounces of silver since January 1st. That's 50 million ounces that walked out the door in just over 5 weeks. But it gets worse. If we zoom out to September 2025, when COMEX hit its peak inventory of 531.8 million ounces, they've now lost 117 million ounces. That's a 22% decline from the peak. In 5 months. Now you might say, okay, John, inventories go up and down. That's normal. Sure. But let me ask you this. When did most of that metal leave? It left during the crash. It left when the price was collapsing. It left when the mainstream media was telling you that silver was dead, that the rally was over, that you should cut your losses and move on. Let me be very specific about the timeline here, because the timeline is everything. Silver hit its all-time high of $121.78 in late January 2026. The very next Monday, it crashed to $71.20. That's a 41% drop. Then it rebounded to $91.75 by Wednesday. Then it crashed again on Thursday night, all the way down to $63.90. During that chaos, during those violent price swings, what was happening at the warehouses? They were being emptied. The withdrawal rate at COMEX was approximately 785,000 ounces per day. Every single day, trucks were pulling up, loading metal, and driving away. While the price charts were painting panic, the physical market was painting something completely different. It was painting demand. Desperate, urgent demand. Now let's go to China. The Shanghai Futures Exchange. This is where the Chinese buy and store their silver. And what happened there is even more shocking. On January 20th, 2026, Shanghai had 618,582 kilograms of silver in their warehouses. By February 4th, just 15 days later, they were down to 423,241 kilograms. Let me do the math for you. That's a loss of 195,341 kilograms. That's 195 tons. That's 6.28 million ounces. Gone. In 15 days. That's a 31.5% decline in 2 weeks. I want you to think about what that means. China, the world's largest silver consumer, the country that uses silver in solar panels, in electric vehicles, in industrial applications that we can't even track, just pulled almost a third of their exchange inventory in the middle of a price crash. Does that sound like weak demand to you? Does that sound like a country that thinks silver is going lower? No. That sounds like a country that knows something you don't. That sounds like a country that's stockpiling a strategic resource before the shortage hits. And here's the kicker. They were paying a premium to do it. While silver was trading at $76 in New York, China was paying $86. That's a $10 premium. India was doing the same thing. $86 while New York was at $76. You don't pay a $10 premium for an asset you think is going to collapse. You pay a premium when you're desperate to secure supply before it's gone. Combined Chinese inventories across all exchanges are now down to 27.1 million ounces. To put that in perspective, during the LBMA crisis, the warning threshold was 153 million ounces of free float. China is now sitting at 27 million. They're running out. And while they were draining their warehouses, while they were paying premiums, while they were frantically securing physical metal, what was the mainstream media telling you? Silver crashes on weak demand. Speculators exit the trade. The bubble has burst. That's not reporting. That's cover. That's the narrative they needed you to believe so you wouldn't ask the obvious question. If demand is so weak, why are the vaults empty? I have the logs. I have the timestamps. The numbers don't lie. While you were staring at the red charts, convinced that you made a mistake, convinced that you should sell before it goes lower, they were loading trucks in Shanghai and New York. They were moving metal from the public warehouses into private hands. From weak hands to strong hands. From the people who panic to the people who plan. This wasn't a sell-off. This was a transfer of wealth. And it happened in plain sight while the media ran interference. Now I'm going to show you the weapon they used to execute this heist. And this is where it gets technical, but stay with me, because this is the proof that this crash was engineered. Daniel Pavlonis from RJO Futures did an interview after the crash. He's a professional analyst. He trades silver for a living. And he said something that should have been front-page news on every financial website. He said the silver crash was a 6 sigma to 7 sigma level event. Let me explain what that means. In statistics, a sigma measures how far an event deviates from the normal expected outcome. 1 sigma happens all the time. 2 sigma happens occasionally. 3 sigma is rare. 4 sigma is very rare. 6 sigma? A 6 sigma event has a probability of approximately 1 in 506 million. That's 0.000002%. 7 sigma? We're talking 1 in 390 billion. To put that in perspective, if you flipped a coin and wanted to get heads 40 times in a row, you'd have better odds than a 7 sigma event occurring naturally in the silver market. But it did occur. It happened last week. And according to Pavlonis, it happened 3 times in a single week. Let me say that again. 3 separate 6 sigma level moves. In 1 week. In the same market. That is a statistical impossibility under natural conditions. That does not happen by accident. That does not happen because speculators got scared. That happens when the market is rigged. When an algorithm is deployed specifically to engineer a crash. When someone with the power to move the market decides to weaponize volatility. Here's how it worked. There's an ETF called AGQ. It's a leveraged silver ETF that tracks silver at 2 times the daily movement. If silver goes up 5%, AGQ goes up 10%. If silver goes down 5%, AGQ goes down 10%. Before the crash, AGQ had $5.2 billion in assets under management. After the crash, it had $1.9 billion. That's a $3.3 billion decline. Now, here's the key. AGQ rebalances every single day at exactly 1:25 p.m. Eastern Time. Every day, without fail, it has to buy or sell to maintain its 2 times leverage ratio. When silver crashed 36% in a single session, AGQ dropped 60%. And because it's a leveraged product, it was forced to sell approximately $3 billion worth of silver futures to rebalance. $3 billion. Dumped into the market. At 1:25 p.m. Like clockwork. And here's the beautiful part of the crime. Actual investor withdrawals from AGQ were only $7 million. $7 million out of a $3 billion forced sell. That means the selling wasn't real. It wasn't organic. It was mechanical. It was an algorithm selling because the rules of the ETF required it to sell. And whoever engineered this crash knew exactly when that selling would happen and exactly how much would hit the market. They front-ran the algorithm. They crashed the price before 1:25 p.m., which triggered the AGQ rebalancing, which dumped $3 billion more of selling into the market, which crashed the price even further, which triggered more stop losses, which created a cascading liquidation event. This wasn't human emotion. This wasn't panic. This was math. This was a weapon, and they deployed it with surgical precision. Pavlonis said he watched traders turn $20,000 into $5 million by buying deep out-of-the-money call options during the volatility. Think about that. Those traders didn't get lucky. They knew. They knew the crash was coming, and they positioned for the inevitable bounce. That's not speculation. That's insider information. That's trading on the heist. Now, I want you to do something. I want you to think critically about what I just showed you. A 1 in 390 billion event. 3 Six Sigma moves in 1 week. A mechanically triggered $3 billion forced sell that was clearly anticipated by sophisticated traders. Do you think that happens by accident? Do you think that's just market forces? Type in the comments right now. Accident or rigged? Let's see what the community thinks. Because I want to know if you're seeing what I'm seeing. If you understand that this wasn't bad luck. This was a calculated, coordinated attack designed to shake you out of your position and transfer your metal into their vaults. I'll tell you what I think. I think this was the most sophisticated robbery in the history of commodity markets. And I think the people who engineered it are counting on you never figuring it out. Now let me show you why this heist worked. Why they were able to shake out the weak hands. Why the public couldn't buy the dip even though silver was on sale at $64. Because you were broke. And they knew it. On February 10th, 2026, the New York Federal Reserve released their Q4 2025 quarterly report on household debt and credit. And the numbers are devastating. Total household debt in America, $18.776 trillion. That's up $191 billion in just 1 quarter. Up $740 billion in 1 year. Credit card debt alone, $1.277 trillion. Let me say that number again. $1.28 trillion on credit cards. That's up $44 billion in 1 quarter. Up $66 billion in 1 year. The average American is now carrying $7,886 in credit card debt, at an average APR of 22.3% for those carrying a balance. And here's the critical part. Serious delinquencies on credit cards are now at 7.13%. That's the highest level since 2017, before the pandemic, before the stimulus checks, before any of the artificial support that kept the economy afloat. People are defaulting. They're missing payments. They're drowning in debt. And that's not even counting mortgages, auto loans, and student debt. The overall delinquency rate across all debt is 4.8%. Student loans are at 16.19% serious delinquency. Mortgage delinquencies are climbing, especially in lower-income areas. So let me ask you a question. When silver crashed to $64 last week, when it was screaming by the dip, who actually had the cash to buy? Not the retail investor. Not the average person who's maxed out their credit cards just to pay for groceries and gas. Not the person who's barely making minimum payments and hoping they don't get hit with an unexpected expense. The banks knew this. They have the data. They can see the debt levels. They can see the delinquencies. They knew the public was tapped out. They knew you couldn't buy the dip even if you wanted to. So what did they do? They engineered a crash to a price level that should have been the buy of the decade. $64. After silver hit 121 just weeks earlier. A 47% discount. And who bought? Not you. The whales. The institutions. The Chinese industrial buyers who are paying $10 premiums to secure supply. JP Morgan, who stood for delivery of 33.45 million ounces by January 9th. 99% of the 8.1 million ounces delivered on January 7th went to JP Morgan. Think about that. JP Morgan, the bank that was fined for manipulating the silver market, is now standing for massive physical delivery. They flipped from short to long. They went from suppressing the price to accumulating the metal. Why? Because they know what's coming. They know the shortage is real. They know that when the March contracts come due, There might not be enough registered inventory to satisfy demand. Let me show you the math on that. March 2026 COMEX open interest, 429 million ounces. That's 86,369 contracts. Available registered inventory, approximately 103 million ounces. But that number is declining at 785,000 ounces per day. First notice day for March contracts, February 27th. That's just 16 days from now. If the registered inventory keeps draining at the current rate, by early March, COMEX will only have about 85 million ounces available for delivery. If just 25% of contract holders demand physical delivery, that's 107 million ounces. They don't have it. If 50% demand delivery, that's 214 million ounces, more than double what's available. You see the problem? The math doesn't work. The warehouse is running out. And the people who know this, the people who have access to the real data, are loading up now while the price is suppressed. They engineered a crash. They knew you couldn't buy. They bought for themselves. And now they're sitting on the metal while the shortage builds. Meanwhile, what happened to gold? Gold held $5,000. Gold found a floor. Gold is being bought by central banks. The People's Bank of China has bought gold for 15 consecutive months. Their reserves are over $369 billion. Why? Because they're de-dollarizing. They're moving away from fiat currency and into hard assets. And silver, which is used in solar panels, electric vehicles, and industrial applications that China dominates, is part of that strategy. China just reclassified silver as a strategic resource. They limited exports. They authorized only 44 companies to export silver. They're controlling the supply because they know it's critical to their technological future. And while they're doing that, while they're securing their supply lines, what's the Western media telling you? Silver crashes on profit-taking. Speculators exit the trade. The rally is over. It's a lie. It's a coordinated narrative designed to keep you from seeing the truth. The smart money is buying. The institutions are accumulating. The vaults are being drained. And the weak hands, the retail investors who couldn't afford to hold through the volatility, are being shaken out. You were the victim. Your debt was the trap. And the crash was the weapon they used to rob you. Let me summarize the evidence. Exhibit A, the SilverSeek headline. Large chunks of silver leave China and COMEX warehouses after latest price crash. The price went down. The metal went out. That's not a sell-off. That's a heist. Exhibit B, the vault drain. COMEX lost 50 million ounces since January 1st. 117 million ounces since September. Shanghai lost 195 tons, 31.5% of their inventory, in just 15 days. Combined Chinese inventories down to 27.1 million ounces. The vaults are being emptied. Exhibit C, the 7 Sigma weapon. A 1 in 390 billion statistical event. 3 Six Sigma moves in 1 week. AGQ forced to dump $3 billion in mechanical selling. This wasn't natural. This was engineered. Exhibit D, the broke consumer. 1.28 trillion in credit card debt. 7.13% serious delinquency. The highest level since 2017. The public couldn't buy the dip because they're drowning in debt. The banks knew this. They counted on it. Exhibit E, the institutional accumulation. JP Morgan standing for 33 million ounces. China paying $10 premiums. Gold holding $5,000 as central banks accumulate. The smart money is buying while the weak hands are being shaken out. The verdict is clear. This was a coordinated attack. A mathematically engineered crash designed to transfer metal from public warehouses into private vaults. From weak hands to strong hands. From you to them. The heist is complete. The metal has moved. And now the shortage begins. Because here's what happens next. March contracts come due. If even a fraction of those contract holders demand physical delivery, COMEX won't have enough metal to satisfy demand. They'll have to either default, which destroys the credibility of the entire futures market, or they'll have to scramble to find metal at any price, which sends the spot price vertical. Either way, the people who bought at $64, the people who held through the chaos, the people who understood that this was a heist and not a collapse, are about to be rewarded. The weak hands are gone. The speculators who were using leverage are wiped out. The retail investors who panic sold are out of the trade. All that's left are the strong hands. The people who understand the fundamentals. The people who know that silver is not just a speculation. It's a strategic resource. It's a monetary metal. And it's in a shortage that's only going to get worse. China's draining their vaults. COMEX is running out of registered inventory. JP Morgan flipped from short to long. The 7 Sigma algo attack worked to shake you out, but it also revealed who the buyers really are. And now I want to hear from you. The vaults are drained. The weak hands are out. My final question is simple. Where does the silver price go in 2026? Will we see $100? Will we see 120 again? Will we blow past the old high and go to 150, 200? Yes or no? Leave your prediction below. Tell me what you think happens next. Because we're watching a market that just experienced a 1 in 390 billion event. We're watching vaults that are emptying at record speed. We're watching institutions accumulate while the media tells you to sell. This is the most important moment in the silver market in a generation. And you need to decide, are you going to trust the mainstream narrative or are you going to trust the evidence? I've shown you the logs. I've shown you the timestamps. I've shown you the math. The data doesn't lie. The heist happened. The metal moved. And the shortage is building. The only question now is, what are you going to do about it? This is John AG. We don't trade the price. We trade the corruption. We follow the metal. We read the fine print while everyone else reads the headlines. And we just watched the biggest heist in the history of the silver market happen in plain sight. The vaults are empty. The weak hands are gone. The shortage is coming. Now you know. If you held through the crash, if you refused to sell when silver hit $64, if you understood that this was a buying opportunity and not a collapse, then congratulations. You just survived the shakeout. You're in the position of strength now. You're holding the metal that everyone else just panic sold to the institutions. But if you sold, if you let the fear take over, if you believe the mainstream narrative that silver was dead, then you need to understand what just happened. You got robbed. They engineered a crash using a 7 Sigma algorithm. They weaponized volatility. They exploited your debt and your fear. And they transferred your metal into their vaults. The crime scene is closed. The evidence is cataloged. The verdict is in. They crashed silver to buy it all. And the warehouses are empty to prove it. Now the shortage begins. And when the March contracts come due, when COMEX has to scramble to find metal that isn't there, when China's already paid $10 premiums to lock in supply, when the retail investors who sold at 64 realize they made a catastrophic mistake, the price is going to move. And it's going to move fast. I'll see you in the next investigation. Until then, stay sharp. Follow the metal. And never trust the mainstream narrative. This is John A.G. Liff, the market detective, the only analyst who reads the fine print while others read the headlines. The heist is over. The shortage is beginning. And the truth is finally out.